Hello, Conrad. Great to see you. We will talk about our financial performance today. However, there were breaking news about the ruling by the Amsterdam court in the context of the ethylene claims, which with quite an impact on our share price, positive one. So what are your thoughts about this case?
Yes, good morning, Kai. A significant impact on our share price, positive. As you say yesterday, there clearly has been a substantial overhang from ethylene claims on our share price. We had a very positive result. The court in the Netherlands dismissed the Shell claim against Clariant and 3 other defendants. It also dismissed the claim of the Stichting ethylene damages, which is also a big win for us. This positions us well for any other court cases, either within the Netherlands or also in other jurisdictions.
So good news for Clariant. Other good news are our numbers. We have delivered a strong set of numbers in the second quarter in quite a volatile environment. So what is your view now on the results?
Yeah, we were pleased with the results. We are disproportionately affected by the conflict in the Middle East. A lot of our customers in Catalyst are in the Middle East, and many of them are actually in shutdown mode. So we saw in the quarter a minus 13% on revenue in Catalyst affected by the Middle East. What is positive is that these declines in Catalyst have been more than offset by solid growth in Care Chemicals, more than 4% growth in local currency, and in Additives and Adsorbents, more than 5% in local currency. So overall, slightly positive for the company, with strong performances in Care Chemicals and Additives and Adsorbents, offsetting the declines in Catalyst.
So good top-line results. Now, how does that translate into our EBITDA margin?
Yeah, what you saw with EBITDA margins up 80 basis points to 18.2% this year on overall flat revenues. I think what is important to note is also the raw material increases. Because of some of the shortages triggered by the conflict in the Middle East, we saw feedstock prices up 7.4% actually compared to the prior quarter last year, the second quarter last year. That 7.4% was more than offset through price increases. So overall, we had about a 3% price increase for the company, which I think is a big testimony to our business model, which is very much based on value-based pricing. We offer substantial value to our customers, and because of that, we are able to pass on these increases in raw material cost.
So pricing is an important aspect, of course. I'm also sure that our performance improvement programs have contributed. What can you say about that?
Yeah, they remain important. In the quarter, we saw an additional 10% of savings coming from the performance improvement programs. We've also increased our target. We had a target of 80 million Swiss francs cost out by the end of this year. We now basically said it's going to be 100 million Swiss francs savings, and we expect to deliver already a 90 million run rate for that program by the end of this year. It is indeed important in the current environment where there is lower growth that we are very much also watching our cost.
Another very strong result, Conrad, after half a year is, of course, also our free cash flow conversion rate, which is far above the 40% that we have set as a target for the full year. So 52%, 15 percentage points up versus prior year. What are the reasons for this positive development?
Yeah, cash conversion is an important target, especially in uncertain times. What was nice to see is that on all 3 dimensions, our cash conversion was up. Better operating working capital management, better operational cash flow generation, and finally, more discipline on our CapEx spending. So really improvements in all 3 areas, a big achievement by the teams.
Yeah, congrats to all the teams involved here. Now let's move on to more the external world and things that will have an impact on Clariant going forward. Let's start with tariffs, because just recently the US government has imposed new tariffs, replacing the temporary ones. What can you say about the impact that these tariffs will have on our business?
Yeah, the impact of the expiration of the so-called 122 section tariffs last Friday And the replacement by these new Section 301 tariffs, the impact is modest because the tariffs are by and large in the same range. Under the prior Section 122 tariffs, we had an upcharge of 10% above existing tariffs. Under the new Section 301, we have an upcharge depending on the country from 10 to 12.5%, and that depends on the level of enforcement of basically avoidance of forced labor in our businesses. What is actually quite interesting, because obviously the chemical industry in Europe is not employing any forced labor, and I can assure you there is no forced labor at any of the Clariant sites. Yet we are now confronted with this new tariffs, 10 to 12.5% under this Section 301.
So limited impact, obviously. So when we were talking about Q1, Conrad, you mentioned that Clariant had submitted claims to refund some of the previous tariffs. Have we made any progress here?
Yeah, I would say we've made excellent progress here. In the last call, we said $17 million is the total amount of tariffs that we were going to reclaim, tariffs that were paid under the so-called Liberation Day tariffs that were put in place. We have actually submitted all our claims for reimbursement. We were amongst the first companies to submit these claims. And I'm very pleased to confirm here that out of the $17 million, we have more than $16 million already back in our bank accounts. So we are here amongst the first companies who got their money back. And I think this is a testimony to the people in Clariant that have been working on this. An excellent job done here.
Fantastic. Conrad, now talking about the Middle East crisis. I mean, this is probably the biggest geopolitical impact that we see. Now, let's remind ourselves that this conflict has started back in February. And shortly after that, many experts said if the Strait of Hormuz will be closed until May or beyond, then we will see a surge in oil prices to levels of 130, 150. Some even said $200 a barrel. Now we see oil prices are actually below 100. Does that mean the worst is over and we can be more optimistic, or how do you assess this development?
Yeah, we previously had a scenario where we expected a reopening of the Strait of Hormuz by the end of June. I think now our expectation is for continued turmoil in the region and in the Strait of Hormuz. What is different is in the previous scenario, a lot of the industry experts expected for a prolonged turmoil scenario, much higher oil and gas prices. So some of the industry analysts expected numbers of $150 per barrel or even more. What we have seen is oil and gas markets more resilient because there were actually bypass routes through the Red Sea, through the Gulf of Oman. What we see is oil production outside the Middle East went up, but we also saw a lot of demand coming down. China, for example, has been able to cut their demand for oil by 50% because of releases from national oil reserves, but also because of a big switch back to coal-based chemistry and coal-based power generation.
But that tells me, obviously, the upstream, so the oil and gas market is not the big issue anymore. However, looking at downstream derivatives and things like fertilizers, we should be concerned because there are no national reserves for that. But if I got you right, Conrad, that would mean, let's take the example of fertilizers, that this will walk its way through the whole value chain and end up, for example, in higher food costs, higher food prices. And that tells me, so if consumers spend more on food, there's less that they can spend on cell phones and durable goods and new furniture, cell phones, laptops, and the like. So that means we cannot expect that much in terms of increased demand at the consumer end. But I know you are always optimistic when it comes to growth prospects. So, Conrad, what are then the growth pockets that we still see despite these developments?
Yeah, first a comment on what you just said, Kai. I mean, we still see elevated oil and gas prices. the real escalation scenario is less expected. But you're right, we see tightness in downstream products, elevated prices in base chemicals, in petrochemicals, where there are no national reserves, where there is no significant excess capacity to absorb the capacity in the Middle East that's constrained right now. It's a fair comment you make. This is inflation. This is triggering inflation. And actually, it is triggering a slowdown in GDP. You see that already. What is interesting is, despite this negative macro for Clariant, we are seeing pockets of growth that are very resilient. We see our additive business supplying flame retardants to electric vehicles. Electric vehicles still a very solid 12.5% expected build rate increase for the year versus prior year. We see actually new markets for us in data centers, where there is actually quite some demand for flame protected coatings. So we also obviously are benefiting from that. We are seeing strong demand right now for purification of renewable oils, biodiesel, sustainable aviation fuel. Finally, what we see is a resistance in personal care, home care. These are the consumer-facing segments in care chemicals. We wanted to prioritize these. That's where we also made acquisitions in recent years. We saw a high single-digit growth in personal and home care in the second quarter. So the company is very well positioned to still deliver growth in an environment where, indeed, as you say, GDP is slowing down, durable goods spending is slowing down, but there are these very interesting pockets of growth that we benefit from.
Great to hear, Conrad. So if we bring all of this together and now look at our outlook and guidance, how does all of that translate into your confidence level regarding the second half of this year?
Yes, so putting it together on revenues, yes, Catalyst has been hit by the shutdown of operations of customers in the Middle East, also outside the Middle East because of feedstock shortages. We see a better second half because particularly the force majeures outside the Middle East are disappearing because customers are sourcing their feedstock from other regions. However, for the year, the shortfalls in Catalyst will be offset by a good performance in care chemicals and in additives and adsorbents. So overall, we think we will end the year with a flat top line in local currency. And what's important is around 18% EBITDA margins. So we maintain our guidance for profitability, which means that in an environment where there are some challenges for growth as a result of the Middle East impacts, in an environment where there are high raw material costs that will prolong for a bit longer, we are able to offset these. And obviously our cost performance improvement programs are helping here as well. So putting it all together, continued strong profitability in an environment that has been affected this year. It positions us also well for next year.
So we end on a positive note. Conrad, thanks so much for taking time. Appreciate your insights, and we will talk again soon.
Thank you, Kai.